Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/rive to receive the top 10 stocks to buy right now. Opendoor reported earnings recently, and I think the results were really interesting because now that a lot of its competitors have left the iBuying market, Opendoor can be a little bit more selective with the kind of homes that it buys, the pricing that it has. And if it gets this business right, this could be a phenomenal investment long term. I'm not ready to say that we're quite there yet, but we're seeing some signs of life. So I want to dig into the results, show exactly what we learned in the quarter. My name is Travis William. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content. And if you're looking for high potential, high growth stocks like Opendoor, check out asymmetric investing. I'm analyzing stocks with 10x potential there. If you like Opendoor, I think you'd like that. And let's dig right into Opendoor's results. Usually I like to start by looking at revenue and where the business is going from an operating standpoint. But with this stock, I want to look at the balance sheet first. Because if there's a huge risk for Opendoor, especially as the stock traded down close to $1 just a couple of weeks ago, it's on the balance sheet. But there's actually a lot of improvement here over the past year. You can see here cash and equivalents $1.14 billion, restricted cash $1.5 billion, securities another $108 million. Real estate down over 50% from just 3 months ago to $2.1 billion. And then going down to the liability side, non-recourse asset-backed debt. So this would be basically mortgages on the homes that it buys, 2.8 billion. And the current portion of that was 3.55 billion. So big reduction in debt of over $1 billion in just the last 3 months. Convertible senior notes also declined a little bit, but that is a form of debt that goes back to the parent company, so isn't backed by an asset like the debt that I talked about earlier. So despite everything going on in the housing market right now, Opendoor's balance sheet is actually getting a little bit better. If we go down to the statement of cash flows, we're going to see exactly what's going on here. The company lost $101 million from a net income perspective, but then you add back all kinds of other things to get to operating cash flow. Sale of real estate inventory resulted in a $2.3 billion increase in cash. So that's that increase that we talked about earlier. That was from selling homes that were on the balance sheet. Also repaid $1.4 billion in debt. So that's how you get to this cash increase of about $900 million in the quarter to $2.7 billion right here. So now that we've gone through the balance sheet and cash flows, what exactly happened with operations? How did we get to that better balance sheet? Well, revenue was $3.1 billion, up from a quarter ago, but down sharply from a year ago. Number of homes sold, 8,300. So again, selling more homes than a quarter ago. And this is really the thing to look at. They break this out by the Q2 cohort. And what they're talking about is the second quarter of 2022. So the old book, homes sold that were bought prior to that Q2 point, generated a gross profit margin of 3.2%. On an adjusted basis, the loss was 8.4% per house, and on a contribution margin basis, negative 13.1%. So basically losing 13 cents for every dollar that they invested in a home. The new book, post cohort Q2, those numbers really turn around. Gross profit margin, much better, 12.2%, and contribution margin, 8.5%. Going forward, we should see this improvement in margins continue. I think that's really the story for Opendoor, or at least that's the hope for investors. We see other improvements in operating expenses. You can see that Q2 2022, $204 million in operating expenses. That's down over 50% to $100 million last quarter. If you start to see those margins turn around, that's where Opendoor could get really profitable really quickly. But that financial turnaround isn't expected to come quite yet. This is guidance for Q2 2023. Now, I'll note that management did say that a lot of the homes that are on the balance sheet are in the old cohort that we talked about earlier. So may not be very profitable. It may actually be a big loss sitting on the balance sheet. Q2 2023 revenue guidance, about $1.8 billion and negative adjusted EBITDA of $180 to $200 million. Some improvements with operating expenses on an adjusted basis dropping to about $90 million. But they did say that that new cohort of homes that they're buying slowly now should start to make up a majority of sales starting in the third quarter of 2023. So that's when we would likely start to see that operating leverage really start to kick in. Opendoor continues to be an extremely high leverage play for investors. This is a company that could lose a ton of money really quickly if home values go south. It could also make a lot of money if home values go up. And the challenge for the company has been that it's been facing a lot of headwinds over the last couple of years. Rising interest rates means that it's more expensive to buy homes. So the company's assets that they bought in one period of time suddenly become less valuable a couple of months or a couple of quarters later. That's the challenge that a lot of these iBuying companies found themselves in. They weren't able to flip these homes fast enough to be able to make a profit. So the adjustments that Opendoor has made to its business to be able to buy homes a little bit more prudently, sell them with a higher margin, that's going to be what drives eventual profitability. What we don't know is what the volumes are going to look like in time, because the company has really lowered the pace of buying homes. And if you're not putting homes through the system and actually generating that 10, 12, 13% gross margin, then you're not covering your operating expenses. So a lot of question marks still facing Opendoor, but this is a company that seems to be turning things around slowly, definitely on my radar. And I want to see at least one or two more quarters of improvement and more stabilization in both the housing market and interest rates before really thinking that this is going to be a long-term buy. But I think we're starting to see steps in the right direction. And the fact that it's really one of the only iBuying businesses left means that it can take the entire market to itself. But what do you think about the quarter? Love to hear your comments in the comment section below. Don't forget to follow Rive Investing and check out asymmetric investing if you're interested in a company like Opendoor. Thanks for watching, everybody. See you here next time.